Hi, I'm JP Scott, CEO of iWealth. I've been helping people create wealth over the course of 35 years. During that time, I've reviewed thousands of financial plans designed by other financial professionals. And one thing I discovered is that millions of their dollars were being systematically transferred away because they're not getting all the facts. I don't know you, but after you watch this video, I'm guessing that you're going to see some things that hit close to home. At iWealth, we developed a wealth accumulation strategy that utilizes all the facts, not just part of the facts. This system is designed to recover millions left on the table, reduce, and in some cases, eliminate unnecessary taxes. And all of this can be done by taking less risk. So before I give you all the facts, let's take a look at what the problem is. The problem starts with two words: deferral and deduction. I guarantee you, your trusted advisors, CPA, attorney, financial advisor, all know the difference between a deferral and a deduction. However, at some point, the words have become interchangeable, which leads clients to underachieve. They underachieve because they believe with a qualified retirement account, there are real tax savings, and they will be in a lower tax bracket when they retire. Unfortunately, these two concepts are exaggerated and misleading. In the real world, there are no tax savings. The Financial and Accounting Standards Board, FASB, recommends these deferred taxes be entered on the financial balance sheet as a debt. And there's nothing more exaggerated or misleading than a typical example of a cash balance defined benefit proposal. This proposal was prepared for 2 doctors and their 9 employees. In keeping with the main objective, this plan illustrates annual funding of $412,000. And by using a 40% estimated tax rate, the proposed tax savings are $165,000. With additional administrative costs and contributions for the employees, the net tax savings are illustrated at $124,000. But as you recall, the Financial Accounting Standards Board recommends these deferred taxes be entered on the financial balance sheet as a debt. To achieve the goal of maximum contribution, you must have a lower investment rate of return. In other words, you must underachieve. So simply put, by underachieving, you don't get more tax savings, you get more tax debt. In addition, the cliche that you will be in a lower tax bracket in retirement is always cited but never quantified. So let's take a look at Gary. Notice the effective tax rate is nowhere near 40%. Based on his $258,000 adjusted gross income, his effective tax rate is 23.4%. So we ask the question, how much does Gary have to lower his post-retirement income to achieve a lower tax bracket? As you can see, by reducing his income $82,000 or 32%, he saved a whopping 2.87% in taxes. Given the choice between reducing his post-retirement income by $82,000 to save 3%, what would Gary or anyone do? But wait, it's actually worse than that. If you look at it in purchasing power using a 2.5% inflation rate, that's the equivalent of $91,000, basically a 53% loss in purchasing power. And all of this to save 3% in taxes? Summing up all the expenses created by these exaggerated tax savings and by using real tax rates, Gary could improve his net after-tax income by almost 30%. That's 30% every year for the rest of his life. If he lived to be 90, that would be almost $2.4 million. Now, imagine a teeter-totter that is level. Whether it's pre-tax contributions with tax-deferred growth and ordinary income on the distributions, or if you change the order to after-tax contributions, tax-deferred growth, and tax-free distributions, it's all the same. Now let's put the employee on the teeter-totter and give them a match without administrative costs. This is a really good deal for the employees. Now let's look at the business owner on the teeter-totter. When you add just the administrative costs, The business owner's after-tax distributions sink by as much as 16%. Increasing the net retirement income, we believe, is the essence of retirement planning. Wouldn't it be better to pay capital gains or just no tax at all? To increase your wealth, others are going to tell you that you need to put more money in. I'm not going to tell you that. I want to tell you that if you understand all the facts, you can create more wealth with your current budget. So click on the button now and get all the facts.